Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's window company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, M&T Bank, MARCUM LLP, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, The Moynihan Group, Margolin Weiner and Evans LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, The Witkoff Group.
Hello, my name is Michael Stoller. So here we are in the summer of 2010. And, you know, there are false pretenses on the economy getting better. The Treasury bills are down at the lowest rates. Mortgage rates are down there. The market is crazy. But, you know, we got to figure out where the market is in 2010. So I took my little crystal ball, very small crystal ball, and I said, you know what? I'm going to ask the next generation of real estate executives what their thoughts are of the real estate market and how they see the world progressing. So my guests today include Ben Levine, who is a project manager at Douglaston Development, Casey Klein, who is a director at Crescent Heights, Joe Kosum, who is a senior associate at Marcus and Millichap Realty Services. I got that right. And last but not least, Andrew Siami, who is a VP Field Operations at FJ Siami Construction. So since you're the contractor, since you're the guy who's building, and you're the oldest one.
Yes.
30, 28, 25, and 25. Yep. How do you see the market? You came into the market when the world was a little tough. You've been in the business really since you're 16, you know?
I've been in the business since I've been 16, and I worked in the field full-time starting when I was 23. I see the market coming back now a little bit of the time. There's still a lot of unemployment in the trades, about 30%, but the market's definitely coming back. I think the banks are starting to lend again, selling distressed properties, and I think it's good for the construction business.
You know, there's this impression that construction costs are coming down.
When I say 30%, I mean that's across the board. So construction costs are coming down, but there's still a lot of unemployment out there, and because there's a lot of unemployment, it reflects a little bit in the construction costs, but across the board I can't speak general. I'm not going to generalize, but it's come down a bit.
Mr. Levine, Douglaston Development is a developer. You also are owner-operator. You know, you have a building, a magnificent building called the Edge in Williamsburg. You have a brand new rental called the Ohm in what we call the West Chelsea or the Highline neighborhood. So how do you see it? I mean, you know, you went into this business. You started after Penn. You went to Credit Suisse, and you went in like when the fire was happening, right? 2007.
I started working in the first week of July 2007. I think that technically the residential mortgage bubble burst the week I started working, so I kind of came into an interesting world. As far as how things are now, at the Ohm, we're pretty comfortable where things are. We're at just about 50% leased now at around $58 a foot. You know, we're going straight through the building.
Now, who's leasing? You know, we had this discussion prior to the show that, you know, the people are feeling a little more confident. What's the profile of somebody who's leasing in the home? I mean, age, you know, are they New Yorkers, are they out-of-towners, or, you know, have they relocated because everybody wants to be in the Big Apple?
You know, I'm going to kill two birds with one stone because we have a pretty similar renter and buyer at the Ohm and at the Edge, and I'll explain them both and kind of the
One is
differences.
in the hippie, you know, in Williamsburg, and
Williamsburg is an up-and-coming neighborhood, like Tribeca, like Soho, like Chelsea. You know, it's up and coming, and while I think that everything that's gone on has slowed the process, it hasn't stopped it, and we believe in the neighborhood, and we're committed to it for the next, you know, for the long term. At the Ohm, I would say that our rental range is mid to late 20s to mid to late 30s. People, creative industries, consulting, advertising, media, fashion, some finance, not as much, maybe 10 to 15%.
are a lot of people renting apartments together, you know, two people, you know, sharing apartments, you know, I'm not saying false walls, which was something that happened a couple of years ago, like Stuytown, but you have a lot of couples or friends, or what do you
Yeah, of course. You know, we see
two incomes, families.
Yeah, we see on a lot of our applications that there is more than one resident. A lot of our layouts, our two-bedroom layouts, are conducive to having, you know, not just a couple, but two different people, because they are very, our two bedrooms are nicer, water-facing, more spacious two bedrooms. We also have one two-bedroom line, which is our G line, which Stephen Charno, who is my uncle and our project manager, and he also oversees the Ohm, calls the you know, the recent college graduate line, which is perfect for two guys that just graduated from college. I think it starts at about $3,600 or $3,700 for a two-bedroom.
We can put four in that, maybe.
Maybe where you're from, but you know, it's tight. Four people
Next
can be.
Next time, Jeffrey, I have the sister on the show, not the.
Listen, four people is you could, you know, but we wouldn't like that because it's a health and safety hazard, and you know, we would prefer.
So you're saying, basically, you're saying that people are renting, and you have to give a little incentives, but you're getting decent rents over there, you know, better than one might expect in today's market.
There's a lot of product on the west side, between Silver Towers and Emerald Green. You have TF Cornerstone. Lila Zarian has a project that's coming on the market. We feel that we're kind of in a different market. You know, we're not on the 42nd Street corridor. We're a little bit further south. That's why we call ourselves in West Chelsea.
I like that there. So hey, the kid from Miami, I know you like being in New York because the weather is much cooler here than in Miami. Yeah. So what do you see? You went into the business like 3 years ago, and prior to that you were with C.B. Richard Ellis. So what do you see, what is Crescent Heights, who's a national company, here we got local guys, you know, how do you see the world today?
Well, you know, coming into the business, similar time in '07, having graduated school and having interned on the commercial side with CB, it was an interesting time. One that we certainly won't forget. I think today, going to Andrew's point, I think we're seeing banks coming back in the market. However, I wouldn't say on a macroeconomic level we're getting better. I think there's an extreme amount of capital chasing real estate transactions today that are all out there for distressed prices, but after you, in the end of the day, more often than not, you're seeing all the deals bid up and you're going back to market. And that's why you're seeing on the commercial side 600 Lex, and you're seeing a lot of 340 Madison, and even in other countries, Washington, D.C. is on fire, Chicago, where we recently bought. So I think there's a lot of capital chasing deals today. And why is that? Because they've sold the story that they could, you know, this is the opportunity. But our jobs, I think jobs will dictate.
But what a perfect lead-in for Joe, okay? Because Joe is in the investment sales. So he's on that market today, You know, you went into the market 6 years ago. As your partner, Peter Van der Rey, said to me, it was a good time in 2008 and early 2009 to write a book, which I'm happy that I wrote the foreword for, because there wasn't too much business, so it was able. How do you see the investment sales, relating specifically to what Casey is saying, you know, and really, you know, to what Ben's talking about?
I definitely agree with Casey. There's a ton of demand in the marketplace right now. A lot of buyers chasing transactions, a lot more investor confidence. People want to buy New York City real estate. We haven't seen cap rates increase so much in Manhattan, below 96th Street. There's bidding wars happening again. We just sold a building on the Upper East Side. We had 50 tours, 20 written offers, and it came down to 3 ultimate bidders. 2 were in an exchange, and you know, they paid 15% more where the market was.
What about getting the financing on this type of property?
That specific property, it was a partially vacant building, so on that side we needed a all-cash buyer. On other transactions, multifamily specifically, the banks are lending at still historically low rates. We're working with a bank right now who just quoted one of our clients on a deal that he's purchasing in the city, sub 5% interest and partially interest only.
Andrew, this is for everybody, not only Andrew, which partially relates to Casey's comment, and I know Douglas and Development. You know, everybody is out there. They all want to buy distressed. Everybody has this feeling that there's great opportunities in distress, and they don't understand what goes into it to buy a distressed loan. You know, it's like looking over there. I mean,
yeah, and that's what puts us in a unique position. You know, we're known for our construction arm in the business. We're looking to focus on expanding our development through our construction expertise. So we like looking at properties distressed, or maybe layouts, or buildings that have foundations in the ground that need a contractor to come in, build it, or change the layout in an apartment because it's just not working in this type of economy. So we're just looking for those type of projects to get involved in, because I think we have the unique ability to make that product better.
You know, people come to you, Joe, and to Peter, and they say, hey, we want an apartment house. I mean, you're talking about this partially vacant building. A year ago, nobody would want a partially vacant building because they'd have to rent them up, right, Ben? It would take them 2 months free rent or something like that. Yesterday, somebody came to me, which is perfect, and he happened to be in the construction business. He's out of it now, and he says, I have this big investor, Goldman Sachs type of guy. He has all this money, and he wants to buy distress. And I said, you know, are you aware of what you have to go through with the foreclosure process? I mean, at least Andrew or Levine Builders and Douglas and Development, you've been in the trenches. You can build over there. I mean, what happens when you see that?
We get a lot of calls from buyers that I want to buy distressed properties, and we're starting to see more distressed assets. We're closing in a week on a distressed asset up in the Bronx where we sold the property a couple of years back, and the owner could not handle the asset anymore and couldn't pay his mortgage, and we ended up losing all of his equity.
So who's selling it? Is it the owner or is it the bank?
This one happens to be the owner, and the bank is not taking a big discount on most of their loans, and I'm sure you guys are seeing that as well.
That's what are you seeing? You know, everybody wants to buy.
We feel that our company, with a 3-headed monster, with Levine Builders, Douglas and Development, and Clinton Management, that we're a great person for a bank to team up with for a distressed property, whether it's something that's in the ground or out of the ground, because we could really tackle it from any angle. I think that something that you can consider a problem or a solution, depending on what side of the coin that you're on, is that the federal government has artificially kept rates so low that banks are basically able to earn their way out of their problems, and they've been able to, extend and pretend on all of these loans. Now, basically, I've been talking to bankers recently who've been saying they're not even extending and pretending anymore. They're just extending because they've earned so much that their capital balances are better.
you know, the interesting thing is if you had a floating rate loan and LIBOR is 0.25%, even if you're paying 4 over LIBOR, you're paying 4.25%.
I mean, you underwrote a deal in 2006 where your LIBOR rate that you underwrote at was 5.5%, and your spread over LIBOR was 3.5%. Your all-in rate for the last 2 years was under 4%.
So that's why a lot of people aren't underwater in those
What
properties.
happens when those loans come to mature in 2011, 2012? Sure.
Well, we're talking.
Then
I'm
you're going to
talking
have
about-
like
I'm
gray
talking-
hair like Casey at
but
25.
I'm talking about
true.
construction right now, but as my dad says, LIBOR is the painkiller that's helped everyone get through
right.
this downturn. Unfortunately, painkillers only last so long before they wear off, and it's just a matter of when does it wear off.
And I just think if you put a product out there that's good enough, people are going to buy. I mean, we're developing a project upstate in New York, Hudson County. We saw that there was some interest up there. We built the first certified passive house in collaboration with another developer, and it's greener than green. It's more rigorous standards than green. It uses 90% less heat efficient.
What price range is the house?
I'd say $750,000 to 1.5. But my father was always into efficient building, and sort of like the Ford model, where you put out more houses at a less expensive price, but it's a good product. Something should turn around, and people will be interested.
I mean, going back to your point about this distress in the market, I think that Ben, Andrew, their companies look at how they can get involved in half-completed projects and use their vertically integrated platform. One thing that we've been, we started when we got out of the market in 06, is we went to a lot of institutions and said, now you have half-pregnant ladies, we like to call them, where you sold half a building and then you have the rest vacant that you're not selling. And we said, we're the best group to manage that opportunity.
Very
because
modest, isn't it?
No, yeah, it's the truth. We thought we were the best because we were condo converters, and that's really, it's a hybrid situation. And the reception we got was, we understand you're more than qualified, and there are a lot of people that are qualified, but the banks would rather pay a retail guy to sit there and sell it out for them, and because LIBOR's cheap, their money's cheap, they don't want to give up any piece of the cake. And truth is that more often than not, the sponsors that got them into the problem are still managing the problem. So distress is not, I think, and because of all the capital chasing deals, that you're not really seeing distress level prices yet, but it will come.
Joe, you brought up before while we were in the green room the 3 Ds?
Correct.
What are the 3 Ds?
The sellers that we're still seeing in the marketplace, you have death, divorce, dispute. And you actually have the 4th D, which is now the discretionary sellers.
What about debt? Does that make it 5?
Maybe we could add debt in there as
I
well.
think that is now its own category.
That is a dispute.
I think that's a little bit more
We
than
can have a
that.
dispute over the debt.
You were saying prior to the show, which is what your dad originally got into the building business, is the affordable housing. And there is, there was a tombstone. I always, for my 10-10 wins or my articles, as you know, you receive them quite often from me. But I caught something today that there's like $100 million of money going to be provided by the New York State Housing Finance Agency for affordable developments. So you guys are back into the affordable, going back to your old roots.
Yeah, well, what I've said recently is that 30 years ago when my father started his company, he was building affordable housing, and now I'm building affordable housing with him, because with leverage levels the way that they are now, the only way to do a deal that makes sense for us, based on our corporate structure, is to do affordable housing.
Now, I'm going to pose the same question. On the construction side, because Siami really, is one of the classiest developer contractors around, and I was joking with you with glass. You can't build affordable housing with glass. But have you done affordable housing? Have you ventured into that?
Development side, no. And we did actually Front Street, which was downtown, which was a couple of years ago, and we utilized the Liberty bonds, and we had 98 rentals. So that was, in effect...
Right, but I think what I'm saying with Ben is more of the true affordable housing, where you get the land. The problem that happened 2 years ago, or, like in 2007, even properties in the tertiary markets were selling for $100 a developable foot, where you couldn't build affordable housing because you need a lower construction cost over there.
Well, just to give you an example, we closed on a site at the end of last year, which is on White Plains Road in the Bronx, and I think that ultimately we closed on the land at a little bit under $30 a foot. Started out above $30 a foot. Unfortunately, it took longer than we expected to get, through the lines with the city to get the project financed.
Now, but here's an interesting discussion on that, and there have been some recent transactions, and I even got something today in the mail in the email from one of your competitors selling a development site, one of them on Greenwich Street, and then there's a couple of development sites. People are, I think, in this irrational exuberance that they're talking about land selling. The public next to the public library, the site across the street, they just sold for like $240 a square foot. There's a site on 54th Street. People are talking about $300 a foot, and with construction costs, it's hard. How could you do something
At those prices? It doesn't make sense. And if you look at other markets, we're building a project in San Francisco right now that we were able to buy our own loan, a land loan at a discount. We think that it really makes sense when your land basis is proper to build. But when you saw the Bryant Park site go for $240 a foot,
the only thing good is, it could have been for his reception for his wedding.
Yeah, it just doesn't pencil.
You had to get it in the show.
Yeah.
Couldn't let him live.
Yeah.
You just had to get it in the show.
His wife will be happy.
Look at him blushing now.
Yeah. It's just hard to make a pencil. But, it is, a lot of people are out there trying to take advantage of manufacturing cost that you could build for, 30%, whatever the number is, less than you could 3 years ago.
The only problem, you have a comment?
Well, one of the things that I wanted to say is that for people that have a lot of cash on hand, like, Glenwood, there are still sites that if you can tie them up and if you have a long time horizon, like you could wait 10 years or 20 years to break even, you got to. I mean, if you could tie up some of the best sites in the city now, that was $400 or $500. That's now $200 or $300, and you got to wait it out.
There's always recoveries. My joke used to be it's a biblical story, and for this, if you go to the Old Testament, they said there were 7 good years, and then there were potentially 7 bad years. Now, fortunately, that 7 bad years, which took place in the 90s, really recovered much faster than this time, as you were saying.
And it's correct, and that's when we kind of jumped on the 80 South Street building in the early 90s, where we bought that building for real low. We were able to sell it for real high, buy it back. Now we have partnership interest, and we're looking to do this project. Investors are talking. It's my father's pet project. It's the one that he's really excited about eventually. But we bought air rights in 2008 for $300 a foot, and are looking to build. We could build 300,000 square feet on that.
The real question, and that relates, and I mean, you happen to your family and the company believes in Lower Manhattan. The question is people believing in Lower Manhattan.
Right.
You got the Trade Center site. You have development over there. People believe that it is becoming more of a 24/7.
My father calls it the hidden gem. I think, and I tend to agree with him. He's on a lot of boards down there. He's with the Alliance, the Seaport. He really does a lot for downtown. And
now, with regard to that, how do you see that on investment sales in downtown? Is there a keen interest of people? Like you were saying, east of north,
south of 96th
south of
Street.
96th Street. What about Lower Manhattan?
Lower Manhattan, there's definitely a lot of interest. We're selling a few multifamily mixed-use assets down there. One happens to be a prime corner on the Lower East Side, where you have stabilized tenants, but you have the future to develop. But you have the rent-stabilized tenants there, which it's very hard to price the air rights today because they're really not worth anything because you don't have a vacant site. And I have to commend the 3 of you for still building in today's market. And because when I get calls for people wanting to sell land, it's very challenging. And
See, but you're realistic. Unfortunately, some of your competitors Everybody sells to a point. All five of us sitting here, but when you go out and you ask a price for something, even with a Glenwood or a very strong person, those people aren't going to spend $350 for a developable site. You have to sit with it. You have to pay the bank, or if you don't have to pay the bank, you have to take money that
you have to have a lot of
Your cost of
money.
capital.
Yeah.
They're still going over 300 bucks a foot now.
Patience.
Certain people can afford it.
Well, I think what's we all saw it with the famous Drake site. No one ever thought that Harry would be able to recapitalize the site, and he was successful. Where there was, he had the note was in the market and no one showed up. So one guy shows up. That's all you need. All it takes is one.
Are we talking about
That's my
4 or
line.
5 crazy investors for?
Yeah, no. All it takes is one.
Street,
But to Michael's point, I think it's really, maybe you see 1 or 2 sites go outrageous numbers, but more often than not, the Glenwoods of the world and the old-time New York families, and you'll see are disciplined, and they understand that their time horizon.
And that's the reason why they have survived through
Right.
thick and thin, because they're not leveraged. They don't take this debt.
Very
They
patient.
didn't take the last nickel. They're patient. When they rent apartments over there, they look at it this way. Many of them have never really been in the condo market. They've looked at it in a different world. So if you had to look at my little crystal apple over here, and how would you look at the end of 2010 and 2011, each one of you?
I think that the Ohm, we're going to hopefully be fully leased by October, November. We'll have a great push through the summer. At the Edge, we're starting to TCO the market right now, and we'll have all
So
the
people are moving to Williamsburg. Everybody likes, and I do. It's a nice. I took the O train there. Okay.
for everybody out there watching the show that hasn't been to Williamsburg, I challenge you to go to Williamsburg.
It sounds like the other Levine.
and if
Next.
you don't,
Maybe I'll go to Williamsburg after the show.
I'll take you for a drink.
I think there's still a lot to flush out of the system, and a lot of the pent-up capital has to spend its money, and we have time.
Joseph.
We see the activity increasing. Like I said earlier, there's a high demand of buyers. There's more sellers coming into the marketplace, and a lot of sellers are taking advantage before these new tax implications and taking advantage of the low interest rates.
I think for us, the construction industry, it looks bright. I mean, we've been through this pre-2008 till now, and we've picked up a lot of work, thankfully, and I think we're in a position now where my father's done great things and played a major leadership role for our company where we could, continue changing the face of Manhattan.
In conclusion, my 4 young real estate executives all feel positive on the future. I'd like to thank Ben, Casey, Joe, and Andrew. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's Window Company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, M&T Bank, MARCUM LLP, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, The Moynihan Group, Margolin Weiner and Evans LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, The Wickoff Group.